Many investors focus entirely on returns while quietly losing a large portion of their wealth to avoidable tax mistakes. These errors rarely feel dramatic at first, but over time, they compound into massive losses that slow progress and limit financial freedom. Taxes are not just a filing obligation, they are a system that rewards planning and punishes ignorance. In this video, you will learn the most common tax mistakes investors make and how awareness alone can dramatically improve outcomes. Like and subscribe to keep learning how smart strategy protects and grows wealth. 1. Ignoring tax planning altogether. One of the most damaging mistakes investors make is treating taxes as an afterthought. Many focus solely on picking assets without considering how gains will be taxed. Taxes directly affect net returns and long-term compounding. Without planning, investors may unknowingly place high tax investments in the wrong accounts or trigger unnecessary liabilities. Tax planning is not about avoidance, but alignment. When ignored, taxes silently erode progress year after year. Investors who integrate tax thinking into every decision preserve more capital and gain structural advantage over time. 2. Selling assets without understanding tax impact. Selling investments without understanding tax consequences is a common and costly mistake. Capital gains taxes depend on holding period and income level. Short-term gains are often taxed at higher rates than long-term gains. Emotional selling during market volatility can trigger unnecessary tax bills. Many investors lock in losses or gains without considering timing. Strategic selling requires awareness of tax brackets, holding periods, and overall income. Thoughtful timing can significantly reduce tax burden while preserving flexibility. 3. Failing to use tax-advantaged accounts properly. Tax-advantaged accounts exist to protect investors from unnecessary taxation. Many investors either underuse them or use them incorrectly. Placing tax-inefficient assets in taxable accounts increases annual tax drag. Meanwhile, placing tax-efficient assets inside protected accounts wastes valuable shelter. Proper asset placement enhances compounding and reduces ongoing tax leakage. Understanding which investments belong in which account type is a foundational skill that separates disciplined investors from reactive ones. 4. Overlooking capital loss opportunities. Losses are often viewed only as setbacks, but they can be strategically useful. Capital losses can offset gains and reduce taxable income. Many investors fail to record or utilize losses properly. Others avoid selling, losing positions, even when doing so could improve tax efficiency. Strategic loss recognition requires discipline and planning. When handled correctly, losses become tools rather than purely negative outcomes. Ignoring this opportunity leaves value on the table. 5. Misunderstanding dividend taxation. Dividends feel like passive income, but they carry tax consequences. Different dividends are taxed differently depending on structure and holding period. Investors often chase dividend yield without understanding after-tax returns. High dividend income in taxable accounts can increase tax burden significantly. Proper planning considers net income after taxes, not headline yield. Dividend strategy must align with account type, income needs, and long-term objectives to be effective. 6. Neglecting required withdrawal rules. Certain retirement accounts require mandatory withdrawals at specific ages. Failing to understand or comply with these rules leads to penalties and forced taxation. Many investors delay planning for these withdrawals until it is too late. Required distributions can push income into higher tax brackets unexpectedly. Proactive planning smooths withdrawals and reduces surprises. Awareness prevents costly mistakes and preserves control over retirement income. 7. Letting emotions drive tax decisions. Emotional reactions to markets often lead to poor tax outcomes. Panic selling triggers taxable events. Overconfidence leads to frequent trading and higher short-term taxes. Emotional behavior ignores structure and timing. Successful investors separate emotion from execution. They rely on systems rules and long-term planning rather than reacting to headlines. Emotional discipline protects both capital and tax efficiency. 8. Forgetting the impact of compounding taxes. Taxes do not just reduce returns once. They compound negatively over time. Paying unnecessary taxes early reduces the base that compounds for decades. Even small annual tax inefficiencies create large long-term gaps. Investors often underestimate this effect. Protecting compounding is one of the most powerful advantages available. Tax awareness preserves growth momentum and accelerates wealth accumulation. 9. Assuming tax rules will stay the same. Many investors plan as if tax laws are fixed. In reality, tax systems evolve over time. Income levels change and policy shifts occur. Building flexibility into investment structures reduces dependency on future assumptions. Using a mix of taxable and tax-advantaged strategies allows adjustment as conditions change. Planning for adaptability is more effective than relying on predictions. 10. Treating taxes as a separate topic from investing. The final and most costly mistake many investors make is separating investing from taxation entirely. Taxes are often treated as a side issue, addressed only after returns are generated, but in reality, they are a core component of net performance. Every investment decision carries a tax consequence that influences timing, compounding, and long-term outcomes. Ignoring this reality leads to strategies that look successful on the surface but fail to preserve value over time. Common tax mistakes rarely feel urgent, but their impact grows quietly over time. Avoiding them requires awareness planning and disciplined systems rather than complexity. When taxes are managed intentionally, investors retain more control, preserve compounding, and reduce unnecessary losses. Smart investing is not only about choosing assets, but about designing strategies that survive reality. Like and subscribe to continue learning how thoughtful structure leads to long-term financial strength and clarity.